Marty Gruenberg has actually been involved with the FDIC as a vice chair and as an acting chair for, I think, almost 7 years before he finally got his permanent appointment. But before that, let me say that we all knew Marty Gruenberg. We knew him as Marty. We have to call him Mr. Chair now. But we knew him as Marty when he was the chief counsel for one of America's greatest senators, Senator Paul Sarbanes. And they did a lot of good things, including during FIREA and the Gramm-Leach-Bliley and a number of other bills in which they really strengthened and made more transparent much of the processes and accountabilities of these institutions. It was Marty who was the chief counsel for Senator Paul Sarbanes leading on this effort. I want to really thank him because Marty is somebody who I have always found personally to be somebody who's a great listener, a real fair person, a very honest person with what his beliefs are, what he feels and thinks, but really a talent more than anybody I've ever met of being somebody who is a great listener, who really is interested in what people have to say, what we at NCRC and our members have had to say. And to have him now ahead, chairman of the FDIC, along with Tom Curry running the OCC. Yes, Sarah Brun-Laskin is not the chair, but she has some allies, like Janet Yellen and others. But we have a team now in place in the regulatory agencies who really get what we're talking about. And it is just such a supreme honor to welcome to the podium my friend and somebody I've admired for a long time, Marty Gruenberg. Please join me in welcoming him.
Good afternoon, everybody. And John, thank you for that very kind introduction. John and I do go back quite a ways, and we have been friends for a long time. I will tell you, though, candidly, John hasn't always been that generous to me. But I am really grateful, and I've had a long-standing relationship not just with John, but with the National Community Reinvestment Coalition. You all have been the standard bearers for the Community Reinvestment Act, which is really a unique and landmark piece of legislation in our system of financial regulation that requires federally insured financial institutions to be accountable to the communities that they serve. And it's now been hard to believe over 35 years. 35 years since the enactment of CRA. And I got to tell you, and I want to, if I may, talk a little bit informally today, because I was actually, John Whitney may not know, I was actually around at the beginning. It dates me a bit, but it's true. I was a law student in 1977, and I was fortunate enough to get a summer internship from my local congressman in the Bronx. I grew up in the Bronx in New York. And the first assignment I had in the congressman's office was to write a floor statement for him on this piece of legislation that was moving through the House of Representatives called the Community Reinvestment Act. And it really sincerely made an impression on me, and I ended up focusing my work for the congressman that summer on community reinvestment issues, obviously highly relevant to the Bronx. And when I finished school, you know, I begged Congressman Bingham for a job. He was a wonderful man, and he thought about it, and he asked me, "What do you think you can do for me?" And I came up with a suggestion that was somewhat unorthodox. My parents still lived in the Bronx at the time, and I knew the congressman needed some help in Washington on legislative issues, And I also knew that his person in his district office doing community development work had just left. So I said to him, you know, I think I can help you kill two birds with one stone. If you hire me, I can work 3 weeks a month in Washington on legislative issues, and I could spend a week each month up in the district working on community development and housing projects. And he says to me, well, Marty, that sounds pretty strange to me, but let me think about it. And he actually got back to me and he said, you know, I still think it's pretty strange, but we'll give it a try. And I did that for over 2.5 years, and I will tell you, I've never had a better job in my career, and never had one that I learned more from. If you want to, I don't have to tell you folks, but working in a district office of a congressman in the Bronx, I mean, I grew up in the Bronx, but I learned a few things working in that district office, and I got to know some exceptional people. You know, the key community group, the district was, my neighborhood was the Northwest Bronx, and the major group in that area, of course, was the Northwest Bronx Community and Clergy Coalition, which is still a major group today. And on my first visit, after I started working for the congressman, I met this fellow working for the Northwest Bronx Coalition named Bill Fry. I don't know if many of you know Bill, but he was then in charge of community reinvestment for the Northwest Bronx Coalition. He sort of introduced me around. Bill today is runs the Enterprise Foundation's work in the New York area, and really a wonderful guy. And Bill introduced me to a couple of people who were running community organizations in the West Bronx. One fellow named Jim Buckley, who was running the Fordham Bedford group, and another fellow named John Riley, who was running the University Heights group. And they took me around the neighborhoods to get a sense of what was going on. And then over the next couple of years, we worked together on any number of projects with local government officials and the local financial institutions in the area. The reason I mention all this is I've tried to stay in touch with the Bronx since then. And last summer in August, Bill Fry, who's now working for Enterprise Foundation, invited me to take a tour of the work that's been done in the Bronx. And of course, you know, I was there and saw what happened in the 70s and 80s, which was, for someone who grew up in the 50s and 60s, to see what happened to the Bronx in the 70s and 80s was hard to describe. And I'm sure you all are familiar with just the extraordinary devastation that occurred with thousands, literally thousands of units of abandoned apartments in the Bronx. So anyway, Bill invited me to take a tour, and I don't know how many of you have been to the Bronx recently, but it's really quite remarkable. I mean, they have rebuilt, and I'm talking about the South Bronx, West Bronx, Central Bronx, East Bronx. They have rebuilt the Bronx really block by block, building by building. And so it's an extraordinary story. And so as Bill has invited me on this tour, and I get there, who's waiting to show me around? But John Buckley from Fordham Bedford and John Riley from University Heights. This is 30 years later. I mean, it's extraordinary. Extraordinary. I mean, these guys have been there the whole time. They were young when they started. They're not so young today. But they've learned a lot. And they are highly sophisticated, and they understand both housing and economic development finance, and they know all the players from the financial institutions to the city to the other community organizations. And they took me around the neighborhoods, and it's an extraordinary story. And the reason I mention it is, it's a story that has not gotten that much attention, but I do think provides enormous insight into what can be done when dedicated people work together and sustain it over time, and have leadership at both the community organization level, at the local government level, and at the financial institution level. And certainly one of the keys to that cooperation that encouraged those parties that I think really did have mutual interests in common was the Community Reinvestment Act. I mean, there's just no doubt about it, because I was there in 1980 when CRA was a new thing. And both the community organizations and the financial institutions were just beginning to learn what it meant and how it could be used. And I will tell you, the communications and relationships back then between the community organizations and the financial institutions was not that great. And the participation of the local government officials was not that great. But CRA really proved to be a vehicle for bringing these parties together to identify the resources they could respectively bring to the table and really make an impact. And literally, block by block, building by building. I mean, as I went through the neighborhoods, I couldn't believe Riley and Buckley were still there, but they're pointing out to me each building on each block as we're going through could tell me who arranged the financing for this, who arranged the financing for that. And they've sustained that for a long time. And the city, to its credit, I think, has had a succession of commissioners for the Department of Housing Preservation and Development who have brought a high level of both commitment and capability. And I think the financial institutions, in significant part because of CRA, have also been in the game for a long time and understand the drill. When there's an abandoned property or a vacant lot or a potential for an economic development project, I mean, these folks have been there before. They know the drill. They know what to do. They know how to put together the different pieces of the financing package. And to do these kinds of deals, as you well know, it's seldom one source, but usually multiple sources of support to make it happen. And it takes a lot of experience and expertise to do that. And it takes people with a commitment to stay and make that happen over time, really to bring about change. And I wanted to share that with you because, it literally is my neighborhood, and it has made a difference, and it is a success story with as great a challenge as any urban area in this country can present. So that if it can be done in the Bronx, I think it's fair to say it could be done anywhere. If people come together and work on it and stay with it, building by building, block by block over time. I really do believe that is the key. And I think it's fair to say that the Community Reinvestment Act has been a critical element in that progress. I wanted to share it with you, and it's why, I think John's point, kind comments at the beginning are true. I think Tom Curry brings a deep level of experience, both from his time as banking commissioner in Massachusetts, as well as on the board of the FDIC before joining the OCC. Sarah Bloom Raskin, of course, was state commissioner in Maryland, and I would note also worked for Senator Sarbanes before. It's a distinguished group of people, I should tell you. But so I think we do have people with not only of goodwill, but with experience and some understanding of the challenges and the importance of this work. So I'm really hopeful that we can make some progress. I think the guidance we recently issued on community reinvestment and allowing institutions that, if they meet their obligations in their service area, to utilize state and regional funds or national funds to make resources available elsewhere, I think is a constructive thing, and to clarify and give guidance for institutions to do that. And I think clearly there are more things we can do, and we're going to be working on that and working on it with you. And I wanted to thank, NCRC. It's part of the point. Sustaining the commitment over time, as I've really come to the conclusion, is what makes the difference, and that's what NCRC has done. You guys have been around for 10, 20, or more years, and that's what it takes. These problems don't get solved in a day or a month or a year. They really require a sustained commitment, really over a career, over a lifetime or more. And to have an organization like you, made up of groups from around the country who share that commitment and sustain it over time, I really do think is the key. It's a part of that story. So I'm actually hopeful that we can continue making progress in this area.
Thank you, Mr. Chairman. So we actually have cards on the table, and the chairman has consented to take a few questions. I neglected to say that. So if you could write a question fairly quickly, but write legibly, we'll see whether we can get some of those questions out. Let me begin with one. So as people are writing, Mr. Chairman, one of the things that's surfaced in the recent application from Capital One, which didn't come before you, but is this notion of considering what is the public benefit relative to an application. What is the benefit to the public of a bank acquiring another bank or expanding? And Dodd-Frank obviously added some language that I think strengthened the importance of that law. And obviously that law has actually been around for some time, and some of the other agencies are quite active in measuring and publishing what that public benefit would be. What is the thinking within the FDIC of how you would approach assessing and commenting on a public benefit during an application process?
That's a good question. I think it is part of the evaluation that we're required to do. When you think about these applications, it has to be more than simply the finances of the application itself, but the consequences of the application to the community and to the financial system as a whole. So I think you really do need to bring a broad perspective. And John, let me ask you one favor, if I may, because I was going to get in my comments, but I went on so long on my personal stories that I got distracted. I wanted to talk a little bit about the work the FDIC has done on expanding access to the banking system. Please do. For everybody in this country. And I'll just pretend I just got a question on that, if I may. Because I didn't, because it's relevant to CRA, obviously. It's one of the things CRA is about. Expanding, assuring access to credit and to basic banking services for everyone. And it's certainly what the FDIC is about, and fundamentally what deposit insurance is about. Deposit insurance is about making people feel secure about putting their money in the bank. And the idea is to bring people into the banking system. And the fact is that there are large portions of our population in this country that either have no access to insured financial institutions and are unbanked, or have limited access and fall into the term underbanked. And certainly one of the things that I felt strongly about since I've been at the FDIC is that this should be a significant priority for us because it's so much a part of why the FDIC exists. And when I joined the board, I asked, do we have any really good information? Do we know who's unbanked or underbanked in the United States? And the answer that came back was there have been a few small studies done by private organizations, but there had never really been a comprehensive survey done nationally of who actually has access to banks in the United States. And we've got this wonderful ability at the FDIC. Can you all hear me? We have this wonderful ability at the FDIC to go to the Census Bureau and ask them to survey things for us. So we approached the census and asked them if they could include in their survey that they do a questionnaire trying to get at the issue of who's unbanked or underbanked. And the census was very responsive on that. And so as a result, in 2009, the census conducted the first survey of who's unbanked or underbanked. And part of the charm of working with the census is that the census will now do that survey every 2 years. So the census did the first survey in 2009, we released it in 2010. Census did the second survey in 2011, we released it in September of last year. And let me share with you both some of the findings of the surveys, and then some of the things the FDIC has been doing in response to it, and maybe then I could take a couple of extra questions if we still have some time. Because the findings are enlightening and significant. And by the way, these surveys were large. They surveyed over 50,000 households nationally. And so we were able to get, as they say, statistically meaningful results, not just on a national basis, but on a regional basis, on a state-by-state basis, and also broken down by the 20 largest metropolitan areas in the United States. So it is by far the most granular information that's ever been available on who's unbanked or underbanked in the United States. And by the way, those surveys are on the FDIC website and available to you. And this is the bottom line. The findings of the two surveys were relatively similar. There are about 8% of households in the United States that have no access to an account at an insured financial institution. And there are about an additional 20% of households where someone may have an account, but those households are still utilizing the so-called fringe financial service providers, the payday lenders, the check cashers, and the rest. Taken together, as defined by the survey, about 28% of households in the United States are unbanked or underbanked. And those percentages go up significantly if it's broken down by income group and racial minority. For low-income households, you got to get me off here?
Well, I got to get them fed, but I want to get a couple of questions before that happens.
All right, I'll make it quick,
Yeah.
and then I'll stop. And actually, they can start serving.
They can, if you don't mind.
Not at all.
All right, we can start serving whoever.
If you don't mind me
Here they
keeping
come.
talking, I don't mind you.
All right.
For households with income under 30,000, over 40% are unbanked or underbanked. For Hispanic households, nearly 50% are unbanked or underbanked. For African American households in the United States, over 55% are unbanked or underbanked. So this is a significant issue, because in many ways, access to an account at an insured financial institution, after having a job, access to an account at an insured institution where you can establish and build a credit record, build savings. The survey found that 10% of households in the United States have no checking account at all. 30% of households in the United States have no savings account. So it really gives you an insight into one of the significant economic challenges we face in terms of expanding access to economic opportunity in this country. And let me just tick off 3 things the FDIC is doing in that regard. The survey asked people, why don't you have an account at a bank or a thrift or a credit union? And the answer that most often came back was, well, we don't think we have enough money to justify having an account. But the second most common answer was they pointed to the minimum balance requirements and the fees associated with having an account as an obstacle to access. And so we spent some time thinking about that. We have a terrific advisory committee on this issue. And the committee came back after studying the matter and recommended a particular kind of banking product, an account-based debit card, as a means of trying to thread the needle of providing people a real account at an insured financial institution, but an account that would also be cost-effective for the financial institution to offer. And the reason an account-based debit card has appeal is because it doesn't have checks that come with it, which is the most costly aspect to the institution of offering the account. But an account-based debit card really gives the consumer really all the other benefits of an account. You can do point-of-sale transactions. You can do ATM transactions. You can walk into the branch of the bank as an account holder to talk to a loan officer about the credit products that the bank offers as somebody with an account relationship with the bank. You have the ability to begin to establish the credit record and history that really becomes very important for people. So we issued this as a model transaction account, and I will tell you, several major institutions in our country are now offering products consistent with that. We are working with the Bank On movement in communities around the country to promote that product, and we think it has significant potential for expanding access. Second, we're looking hard at the small dollar loan issue. You need an alternative to payday loans and overdrafts to meet small dollar loan needs. It's clearly a crucial demand in our financial system that's not being well met right now. And we did a pilot project with 9 institutions around the country offering a small dollar loan product at rates that we think are reasonable for the product. And the pilot was quite successful. All 9 institutions were really able to demonstrate that the product is viable, and it's something we're going to be working on with institutions around the country. And the third and final thing I would point to that all of us should take a look at is the potential for mobile banking to expand access to the banking system in the United States. You know, this mobile banking thing is pretty tantalizing because the populations that I mentioned that are overrepresented in terms of lacking access to the banking system are precisely the same populations that are overrepresented in terms of utilizing mobile phones. So that if we can find a way to utilize mobile phones to actually provide bank accounts, it may hold some meaningful promise to expand access to the system. It gets complicated because there are a lot of security and privacy and other operational issues associated with it. But these are issues that we are spending a lot of time on, and I think very much consistent with the mission of the FDIC, and I think with the purpose of the Community Reinvestment Act. So while I'm here, I figured I would at least throw that in as well. Thank you all very much.
Thank you. Marty, before you disappear, a couple of questions. The first one is, please, can we have expanded assessment areas soon?
Well, I think frankly, this proposed guidance is one step toward giving clarity to institutions that meet their local assessment needs to provide credit beyond it. And I think certainly one of the key challenges, there's been enormous change since CRA was enacted in 1977 in this area and in the way institutions conduct their business. And looking at how assessment areas are drawn is something we should be focusing on. I agree with that.
So let me ask the last question and allow you to have lunch if you'd like. Does the FDIC have plans to expand its Alliance for Economic Inclusion to additional cities?
The answer to that is yes. For those of you who don't know, one of the things that is good about being at the FDIC is when you call a meeting, bankers tend to come. And that's a very constructive thing. And so we came up with the idea of trying to encourage local partnerships around the country of community organizations, local financial institutions, and local government officials. Really the kind of partnership that I talked about that I think made such a difference in the Bronx. And to try to do that in communities around the country. And we now have, I think, 17 of these local partnerships that we've helped set up. I think they really are making a local impact in terms of expanding access to local financial institutions, and we will be continuing that work and expanding it to other neighborhoods.
So please join me in thanking our friend, our ally, the chairman of the FDIC. Thank you.